Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, a network for family offices based in Greenwich, Connecticut. Our next Family Office Summit is on November 20th in New York. It will feature Mitch Julis, co-founder of the legendary Canyon Partners, Jose Minaya, head of investments at BNY, and former podcast guest Ken Kinsell, president and CEO of Churchill Asset Management. They will be led in a special conversation by Jennifer Prosek, head of Prosek Partners, also a former guest of the podcast. Please subscribe to circulus.substack.com to stay in the loop. Lawrence Calcano, the CEO of iCapital, began his path to finance with a surprising fork in the road, a theater audition on the very same day as his Morgan Stanley interview. That moment set the stage for a remarkable career shaped by both creativity and strategy. Lawrence discovered that the same skills that bring a story to life on stage are just as essential in building successful teams and businesses. From helping to build Goldman Sachs' East Coast tech group in the early 1990s, when the internet was a fire hose of innovation, to witnessing the highs of the Netscape IPO and the lessons of the dot-com collapse, Lawrence has had a front-row seat to the evolution of technology and capital markets. Now, as the leader of iCapital, he shares how the firm has invested over $700 million in technology to tackle one of wealth management's biggest challenges, expanding access to alternative investments for high-net-worth investors. Calcano opens up about the early skepticism from fund managers, the chicken and egg dynamics of building a two-sided marketplace, and how a relentless focus on education, access, and automation helped iCapital reshape the industry. Lawrence Calcano is the chairman and CEO of iCapital. iCapital now services more than $219 billion of client assets on the platform, across more than 1,760 funds and 106,000 underlying accounts. Prior to joining iCapital, Lawrence was a partner and managing director at Goldman Sachs for over 17 years, including serving as the co-head of the Global Technology Banking Group. Lawrence has appeared on the Forbes Midas list 5 times. Lawrence received a BA from the College of the Holy Cross and graduated from the Amos Tuck School of Business at Dartmouth as a Tuck Scholar. Please enjoy my conversation with Lawrence Calcano.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
The road not taken. You mentioned before that you had a theater audition on the same day as your Morgan Stanley interview. How deep was your interest in the theater?
It was deep. I did a lot of theater in college. I played hockey in college and I did a lot of theater in college and enjoyed it and thought about doing it professionally, but decided that I wanted to eat regularly. And I didn't think ketchup was a vegetable, not to contradict our former president, but it seemed like a risky route. But turns out there's a lot of risk in life, and I don't regret not doing it, though I did enjoy it and miss it a little bit.
What was your initial interest in it? What were some of your favorite playwrights?
Shakespeare, big favorite. We did a lot of that in college. I liked a lot of the Eugene O'Neill, Arthur Miller, a lot of the American playwrights. For pretty wide-ranging. We studied a lot of things, and I think I ended up taking at least as many, if not more, theater classes as I took economic classes in college.
Was that common?
No. Definitely not.
Do you think theater and the liberal arts in general is a good background for this industry?
Well, I think theater is a very good background in a sense that you have to be creative. You've got to figure out how to breathe life into a character in a way that's interesting. If you're a director, I did some directing as well, you've got to figure out how to orchestrate lots of different needs into a cohesive show. So I think there's a lot of things that you can learn in theater, and then obviously communications and presentation and so forth, which is important in almost anything. But the disciplines in theater, I think, are incredibly valuable to have in life. Like remembering lines.
Yeah.
Yeah, exactly.
How did you find your way to Goldman?
It started with finding my way to Morgan Stanley as an analyst. And I worked there for 3 years, really enjoyed it. At one point, actually had accepted a job to stay on, and then thought the better of it, thought going to get my MBA would be a better thing. Because I was a liberal arts major in college, I felt like going back to business school and doing finance and accounting and really drilling in would be better foundational skills. And so I went off to Tuck and loved it. It's where I met my wife. I did my summer associateship at Goldman Sachs and loved it, and then got a return offer and rejoined. When you go to business school, they have, particularly for investment banking, a great process through which you can interview and meet the banks and so forth. I ended up in what was then called global finance, which was really corporate finance, but they called it global finance. And then after 2 years of working in global finance, I was asked to start an East Coast tech group. Our tech group at the time was like 3 or 4 people. It was all based in San Francisco. And there was really nobody on the East Coast doing tech. This is circa 1992. And I said, sure. The funny thing is I had been asked to do 2 other things before that. I had been asked to go to first LA, and my then girlfriend, now wife, her father had just passed away. And so that didn't make sense. And then her mother sadly got sick with some cancer. And they asked me to move, and I said, I'll do it if I have to, but it's not a great family time. And Goldman was super understanding, and they said, you do not have to move, take care of your family. Then they asked me 6 months later to go to San Francisco, and I said, do you remember we had this conversation 6 months ago? And they were like, absolutely. I was excited that they were thinking of me for things. And then I was asked to start the East Coast Tech Group, and I didn't particularly have a background in tech, but I felt the karma was bad to say no to a third thing. What's that old expression, 3 strikes and you're out? So I decided to do it, and not that it was a big decision, I was very excited to do it. And it turned out to be a great move because a few years later, the whole internet boom started, and we were drinking from a fire hose living in the middle of that.
So when you say East Coast tech, that's like Route 128, it's
Route
healthcare.
128 was a big part of it, the whole Boston area. There was a lot going on in Washington coming out of the DOD and so forth. Carnegie Mellon, some startups coming out of there. So it was really the East Coast. There was a lot going on. And then I traveled in Europe. There was a thing we called the E-Valley. There was a lot going on in Europe as well. So it was a big business. When we reached the peak in '99, it was $1 billion business. It was a big business at Goldman from a banking perspective. Very exciting, and it was a great you met with entrepreneurs, people, really smart people with incredible ideas about how they were going to change the world. It was really exciting. And I remember we had these internet projections, like what we thought the internet would become, and at the time, everybody thought our projections were nuts. They were sitting there saying, you guys are breathing in your own exhaust fumes because these are very aggressive. And it turns out what was wrong is the speed with which they would happen. But what was also wrong is the size, so that it was too small, because it became an even larger business than we could ever have imagined. Could you imagine today living your life without the internet? And back then, I remember people saying, including my wife, by the way, I will never put a credit card number into the computer. That seems crazy. Now we all do it routinely, obviously, but it was just an incredibly exciting time to see all that change. And what was interesting is a lot of these people were younger than I was, and I wasn't that old, I was in my 30s, but a lot of the entrepreneurs were even younger than that, and you really felt like you could actually help them. They had incredible knowledge and experience in technology and what they were doing, but maybe less experience in the capital markets and how to finance the business and so forth. And working with the venture community and others, we could really deliver value to these entrepreneurs as they were building their business. So it was incredibly exciting.
What was it like on your side? You guys had to rapidly get up to speed on all these different technologies, and the innovation was moving pretty fast.
Pretty fast. We had a great team, and I think one of the things about my experience at Goldman, which I'll always remember, was it was truly incredibly team-oriented. The combination of our team in banking with a great team in research and a great team in capital markets and sales, we all worked really closely together. And we had some incredibly talented research analysts on our team. And all of us working together was just super effective. And I will tell you, coming away from that, our franchise was particularly competitive and successful in terms of winning mandates for big IPOs and M&A and so forth. But it was because of that team event, that the way in which we all worked together, it was very powerful. And it's definitely something that I've carried with me since. And as we were building iCapital, fundamental to at least my view, and I think everyone has bought into this view of success, is how do you get a lot of really great people to work together? And if you can do that, it's very powerful as you build the business. So there's so much I learned from that I think about every single day today.
What was the impact of the Netscape IPO on your work? Was that pivotal to that decade?
The Netscape IPO was the big first one. And I would say that there was a long line of IPOs behind that came out in its wake. And it really opened up the market. And one of the things about really all these companies back then is their financial models were relatively immature. And I'm using that to be nice. Some of them were highly immature, but a lot of the companies were fairly early stage they'd built great technology and they were only starting to commercialize it. And so a lot of the investors had to think about how to value these kinds of companies, really in the absence of the traditional metrics that they looked at to evaluate companies. But it was the opening IPO, I'd say, of the era, but a lot of great companies followed. And some of them went on to become even more successful, like Amazon and so forth. Others didn't make it. And I think a large part of that was around who executed, whose model made sense, and who executed. And that, again, is, I think about iCapital, execution, I think, has been one of the really empowering things around how we help our clients and so forth. But a great idea on its own, certainly the history of the internet proved this out, but a great idea on its own, a great market on its own without good execution doesn't work.
So maybe drill a little bit deeper on that. I'm curious what you were seeing in these companies in the 90s that eventually became successful. What were they doing then that gave them those advantages?
I'd say companies, one of the first things you're looking for in a company is what is the market they're addressing. You want to find very large addressable markets, and then you're looking at the teams. Almost before the technology, you're looking at the teams and saying, is this a team that's going to be able to execute against this large addressable market? And obviously part of the evidence of their ability to execute is the technology they built. But technology alone without great management team doesn't work. And so we would always look at the quality and the size of the market and the quality of the management team and then their technology. And there was, I think, a lot of, over time, overlap between great managers and great technology because they knew what to build to address the needs in the marketplace. So that's how we thought about it.
Could you tell us a little bit about the UUNet IPO?
Sure. So UUNet, which was a company founded by Rick Adams and John Sidgmore, who was the dad of Michael Sidgmore, who a lot of us know and respect, was a terrific time, was one of the first internet access companies. I remember we took that company public in '95, and there were a couple of companies that were offering to enable access to individuals from their homes to the internet, which is a huge thing. AOL had their walled garden offering, which a lot of people were using AOL. AOL did an incredible job in terms of marketing. But UUNet was really a pioneer in providing the access to all of the internet without necessarily the walled gardens. And it was a very successful IPO. John was a tremendous CEO, had great vision and great execution capability, and they executed really on a comparative basis better than anybody else in the space. And then a year after the IPO, they ended up selling the company to MFS, which itself a year later sold to MCI. And so it didn't have a long public life, but it had a very successful public life. It had precisely one annual report, which I still have somewhere in my library at home.
What was the post-dot-com collapse like for your group? What's it like being an investment banker when the windows close?
It's tough. As a banker, you're always trying to figure out how can you help your clients. And that includes how can you help them finance, how can you help them on the M&A side. And when the market collapsed, there was cut out, particularly at that time when so much of the financing calendar was driven by IPOs. That obviously dried up. Follow-on offerings dried up. And M&A really dried up because executives tend to really hold back in periods of uncertainty. The M&A calendar just really grinds to a halt. So there's not a lot to do in terms of actionable assignments and engagements. So what you try to do is spend time with your clients and figure out how they're thinking about the world and how you can help them and sharing observations of what you're seeing and so forth. But it's a time where you really spend time staying close to your clients and trying to help them in whatever way you can, just processing what's happening and so forth. And there are a few opportunities when things are off kilter to maybe be opportunistic and help somebody maybe make an acquisition and so forth. But it's a tough time, and so you've got to put your head down and stay in front of your clients and try to be helpful however you can.
What are your thoughts on the dearth of tech IPOs today and the many funding rounds that these companies take?
I think, look, we've stayed private. We're in that mix. I would say today the opportunities that the private markets afford companies is tremendous. We've done 5 or 6 rounds of financing. We've raised $1.5 billion, roughly. We've done follow-on secondary offerings for employees to get liquidity, since the equity is a big part of people's compensation. We've made 24 acquisitions, all through the private markets. And so we are huge believers. Obviously, it's our core business in providing access to private markets, but the private markets are massive. And I would say if you look at the number of private companies that are out there to invest in, from an investor's perspective, there's 100,000+ private companies to invest in, and there's 5,000 public companies. And that's not to say public investing isn't really, it's critical, obviously. To have access to the private markets really creates a much larger pool of investment opportunities for clients. And both from the company's perspective as well as from an investor's perspective, the private markets play a really essential role.
So classic question, I'm sure you've gotten this many times. I was actually allocating back in '05, and there were a number of nascent platforms. So why didn't Goldman spin up an iCapital in 2005? What specific technological innovations had to happen before iCapital became possible?
I think it's interesting. You're asking a question that could be generalized to innovation broadly. Why does Apple exist? Why does Amazon exist? There was no online commerce before Amazon existed. It was tiny at best. eBay, same thing. And I think part of it is just seeing a need. We see this all the time. We fight this. When you're running a business, and particularly a large, successful business like Goldman Sachs and others, you're really focused on doing a great job for your clients. You're really focused on executing against your business. And sometimes there are things that are really adjacent to what you're doing that you easily see and you expand into. And other times there are things that are not so easy to see and you don't invest in it. And that's when new companies come along who see different things that people need, and they build them and they hopefully execute well and create new companies. We saw an opportunity for high net worth investors to get access to alternatives, and it needed technology to facilitate that. But we focused exclusively on that and built out, we've spent $700 million building out a technology stack with the real purpose of helping investors get access to non-traditional assets like private equity, private credit, real estate infrastructure, structured investments, annuities, et cetera. But it was seeing a need that was underserved. And I can tell you, 10, 11 years ago, when we were getting rolling, I spent a lot of time on the road talking to general partners. And a lot of them, frankly, were so successful in marketing their funds to institutions, they were already turning away institutional dollars, let alone looking for new dollars from high net worth investors. And so a lot of GPs were not really focused at all on this channel. And the other thing is, I think people had some wrong assumptions about our channel and thinking that private retail investors, high net worth investors, were not sticky, they were not long-term, all of things that are just not true. This is a sticky, it's a long-term oriented channel, it's a relationship-oriented channel. And I think a lot of people, because of the success they were having with institutions or in other businesses, just didn't embrace this. And I think we saw it as an opportunity and began building it out. And obviously, as we sit here today, everybody knows how big the channel is, $145 trillion in wealth held globally, according to Bain. People see this as a big, important channel. And now really every GP is focused on it to some extent. And most of the distribution platforms want access to alternatives and want to increase their client exposure to alternatives. So we feel very fortunate to have seen this. Again, as I said earlier, it's about execution. It's about like really seeing what will serve your clients. When I talk about execution, I mean seeing the need or the pain points your clients have and building that which addresses their needs. And as I say to our team literally every week, multiple times a week, we're here to help our clients achieve their goals, to help them be successful in meeting their objectives. Because if they meet their objectives and we help in that, we have an opportunity to exist another day. And I think execution to me is all about helping your clients achieve their goals. And if you do that, you can create a long-term and important position for your company.
Going back 2011, 2012, what was the seed for this idea like? When did you first sit up and say this could actually work?
So there were a handful of people who had the similar seed, and several of my partners here, Dan Vinay, Nick Veronis, John Robertshaw, were coming together and seeing, it was actually, it's interesting, it was a twofold opportunity that people saw. One was the opportunity we're executing against, and the second was to bring workflows, automated workflows to the institutional market. And I was more focused on the high net worth space, and I knew John Robertshaw really well. He was a good friend, and I had sent him a note, and we all agreed to do this together. And it was fun, and people saw a big opportunity. We had to make a decision early on, which is to stay focused on the high net worth space. And I believed, and I think the board agreed, that it would be tough to build an institutional business back then, but if we succeed, the opportunity to then bring automation to the institutional business will come in time. So we really focused on just helping the high net worth channel succeed. And when I say that, both the distribution platforms, the advisors and their clients, as well as the GPs, because they both had different needs, right? GPs wanted to access this very fragmented market of high net worth advisors, and high net worth advisors needed access to great alternative products. And so we came together and got really focused on providing the whole value chain. And I think one of the things that's turned out to be important in our growth has been building out the whole value chain. And when I say that, I mean building out distribution capability, building out research capability, building obviously access to great funds, and building automation to allow an independent advisor to be able to automate the whole journey, everything from how you learn about a fund, how you subscribe to a fund, and then automation of all the workflows, the capital calls, distributions, reporting, et cetera. And by building out that whole ecosystem, instead of just distributing or just researching or just automating, which other firms decided to do pieces of it, by building all of it, it allowed us to compete as different people came online and from one perspective or another said, we want to embrace this. We were able to respond really to all the RFPs in the industry. And I think that really helped us. And I felt in the early days, like, we think it's all important. We don't know who's going to need what, but we think it's all important. And we decided to deliver our solution on a modular basis. So if you're an RIA and you need access to great managers, you need access to research and technology, we could provide all of that. But it turns out if you were a bank and had all the access you want and all the research they needed, they just needed the technology and or the ability to have someone outsource the processing. And so we were able to respond, because of the modular nature of what we had built, to all the different kinds of needs that were in the industry.
Did you know that you were going to have all those modules to begin with? So I'm wondering, building two-sided marketplaces are really tough.
Really tough.
So I'm wondering, like, what were those first days like? What was the first thing I got to nail down is, like, the Blackstone investment was key, obviously. How do you handle that chicken or an egg problem?
So it was indeed a chicken or the egg problem, but we explicitly decided to build out the end-to-end solution. So everything from all the technology to the ability to do research and select funds and distribute the funds. So we explicitly built out all of that from the very beginning.
Did you have a model for that?
There's no model for any of this stuff when you get going. There's no model for it. But we had a belief that if we built all of that out, we would have a chance to, because all of it's important. If you think about what's important from the helping an investor be successful or helping a GP access an investor, in this case, a high net worth investor, it's all important. And as I said earlier, some people had decided to just build technology to process that. But if you don't have a fund, you don't need technology to process it. Other people built out the ability to distribute funds. Some people hired a third party to do research and distribute funds. We felt like all of those core components were critical to own and insource. And that way, again, we could be maximally responsive to the needs of the marketplace. And again, I think that was really the right thing for us to do, to build that end to end and then let people use it as they needed and not force them to buy the whole thing, if you will, when they didn't need the whole thing.
What were the initial challenges in signing up institutions?
I'm going to come back to your chicken and the egg comment because they didn't hit that, because that's really the biggest challenge. So on one hand, you're talking to RIAs, and the original focus of the business was really RIAs. And we didn't know for a couple of years that the big banks, they obviously had all the access they wanted, but didn't necessarily have technology. So we learned a few years in that we would have a technology opportunity with respect to the banks. But in the early days, we knew that the independent marketplace really needed access to GPs. But of course, they would say, who do you have on your platform? And we knew that the GPs, those willing to talk to high net worth investors at the time, would say, what RIAs do you have on your platform? And so managing that and really telling the story of where we wanted to take this was really critical. But managing that chicken or the egg problem was absolutely a huge challenge in the beginning of this company. And I remember with the RIAs, I used to think we had two sales cycles. The first sales cycle was getting them to adopt a free platform. We didn't charge them to adopt the platform. So it took a year to get them to adopt the platform. And then it took another year before they would actually buy anything of the platform on behalf of their clients. And it was definitely a big chicken or the egg problem. I would say one of the things that I'm most proud about was we really stuck with it. I like to say to our team, you need to have the courage of your convictions. And I think a lot of times in technology, companies pivot too fast. They have a view that the market needs this, and they get a couple of bad pieces of information and they pivot. Pivoting is certainly important, but you've got to know when to pivot versus when to stick with your views on things. We certainly have had sort of pivots over time where we've added things. I mentioned like the banks, for example. But even though we weren't selling a lot of stuff in the first couple of years, we really felt strongly that alternative assets had an important role to play in client portfolios. And we really felt like the GPs were going to be very interested in this market given its size. And so we stuck with the core mission. And obviously I'm glad we did, because it turns out that those two things end up being true.
What were the pain points that you were solving for those institutions? Back in the day, allocating to big funds involved a lot of paper, and it involved a lot of meetings.
Yeah,
so I'm sure that was part of it.
All of that was part of it. But even before that, it was just understanding the marketplace. What is private equity? How does it work? And back then, now we do as much private credit as private equity, but back then it was predominantly a private equity marketplace. It was understanding how the funds worked. It was helping people understand that it actually really mattered who you invested with. If you're in a long-only fund, long-only domestic equity fund, the difference between the best one and the worst one is 250, 300 basis points. In alternatives, the difference between the best equity manager, top quartile, and the fourth quartile is like 1,000 basis points. So you're really not in the asset class you think if you're in the wrong managers. And so helping people get access to the right managers was a really critical thing that we were solving for our distribution platforms and the advisors and their clients. And then beyond solving that, education, which by the way, continues to be massively important. So education, access to the right managers, and then all the automation to process. All of that played a really important role in trying to solve problems for the distribution platforms. And then on the other side of the table, because everything we think about multiple sides of the market, it was helping the GPs get access to, again, a very fragmented market. And some of the firms had made big investments in terms of people going out and reaching the market, and others just had less bandwidth there. And so we were really supplementing what they had in place to call on this channel. And that's why we built a distribution team to be able to help with that. So different issues depending upon where you sat in the value chain, but obviously all important needs that we thought we could serve.
You've just raised capital and made some notable acquisitions like Mirador and Parallels. Maybe talk a bit about the rationale for those. And as a former banker, what do you look for in an acquisition?
As you live in a world and you help your clients, you need to understand what you need to do in your core business to help improve the service to them. And you also watch and you see where they have other pain points. And some number of those pain points are immediately adjacent to what you're doing. And in both those cases, we felt like we could solve real problems. So take the data problem. As we look at the market, take an RIA, for example, many of the RIAs that we see today are growing and scaling both organically and inorganically. And they're buying other RIAs. And as a consequence of that, they have data that resides in many different places. And aggregating all that data and bringing it together in one place is a huge pain point for a lot of our clients. And the same is true, by the way, at wirehouses and IBDs and so forth. And so by acquiring Mirador, and we acquired a second company called Alt Exchange, which we've now put together with Mirador, we're helping to solve this problem of data residing in lots of different places, to bringing it together, aggregating it, and putting it in a place that the client wants it, whether it's in a reporting package most often or in some other place where they can then use that data more efficiently. That, by the way, is an area where we're making significant AI investments. The process of automating, gathering the data, going out and gathering the data, extracting data from a document, and then aggregating the data. There's a lot of opportunity for the use of AI in the context of that value chain. So that was a huge, and by the way, that pain point is growing, and we're seeing this business grow. We're now managing roughly $520 billion in data assets for people, where we're going out and collecting that information and bringing it to a place where they can report on it. The Parallel Markets acquisition was all about the problem we watch all the time with AML and KYC. You can be an investor, you can be investing in a Carlyle fund, and you buy fund one or a Blackstone fund, and you're doing the same thing twice as you go through that process. If you buy a second Blackstone fund, you're going through the same process even though you've invested with that manager previously. And so creating a mechanism to automate that, and in effect what we're building is a passport. So people go through the process once and then we'll keep it up to date, so the GPs don't have to go through all that process. And by the way, it's a huge issue for the wealth management side of the equation as well. Trying to automate that for both wealth manager and the GP is a huge lift in the market. Again, seeing a problem that is attendant to every one of these investments and trying to automate that is really how we're trying to solve problems. And by the way, that becomes thematically, to your second question, what we continue to look for on the M&A side. What are all the areas that are, again, adjacent? We don't want to solve a problem that has nothing to do with what we're good at, obviously, but what are the problems that are adjacent to what we're doing, where by adding something new to the mix, and we always have a build buy, is there something we should build versus buy? And there are some, by the way, there's a lot of things that we end up building that we don't buy. Obviously, you don't announce those things. But what are all the things that we can do together that create a larger, more powerful platform from the perspective of serving customer needs, whether that's a GP, wealth manager, a custodian, administrator, because part of what we're trying to do is really help the ecosystem. It's not just a two-sided market, though that's where we've spent a lot of time. There are other really important constituents in this market that we're trying to help with this automation and connectivity, as well as the wealth advisor and the GP.
What have you seen from GPs who've had success selling into the wealth channel? What have they done to educate the wealth channel and on where this fits into a portfolio, et cetera, and why it should be there?
They're committed to it. And I would say in the early days, there were a number of asset managers that were really running their high net worth business on the side of an institutional fundraiser's desk. The folks that have been most successful in this wealth channel have been super focused on it, have a dedicated team of people that aren't making decisions about whether I'm going to call on a big institution today or high net. All they focus on is high net worth. The GPs are building product focused on this channel. They cover the channel, they've built relationships with the channel. And just if you go back over time, the best GPs built great relationships with their institutional investors. They called on them. They talked about the products they were considering building. They talked about how their investments were going. They met with them between fundraisers, not just during fundraisers. And that same relationship building exercises are exactly what the best GPs have done with respect to the wealth channel. And that to me is really key. Building relationships, focusing products, understanding that this channel is different than the institutional channel, and catering to the uniqueness of this channel from a product and calling and relationship building standpoint.
One of the interesting things about these platforms is they start to have a real effect on the cost structure. What are your thoughts around fee compression as this market becomes more efficient?
It has to happen. And I would say, like, fee compression, I think of it as really cost compression, because the actual expenses to the individual who's the investor, the advisor, and their client is a function of lots of different things. It's obviously a function of the fees that get charged by GPs, that iCapital charges. It's also a function of all the expenses along the way and the costs of connectivity. If you think about historically a fund that would have been marketed to high net worth channel, you have multiple constituents in that chain. You have the GPs, obviously, who are managing the funds. You have maybe an iCapital. You have an administrator or a transfer agent. You have an auditor. You have a tax preparer. You have the underlying advisor. You have the client. And every time there's a transaction, that could be a subscription, it could be a report, it could be a capital call, a distribution. You have 5 or 6 different people actually reconciling and updating their systems. There's a lot of inefficiency in that. There's a lot of redundancy in that. So one of the ways in which you can actually reduce that friction, reduce the need to have multiple points of reconciliation, we're focused on overall cost. That's an area where we've been focused on using distributed ledger technology to address all of the redundant reconciliations that take place in the industry and really take out a lot of the inherent costs of connectivity. The people shouldn't have to manually input into 5 different systems. And those are things where we think there's both explicit costs, but also issues around mistakes that get made when multiple people are manually inputting information. So we think there's a lot of ways to take down the overall costs of investing in these types of assets that will make the net returns much higher for clients, but also make the experience better. And that, to me, is very important. What is the experience for the advisor, and what is the experience for their underlying client? And by the way, what's the experience for the GP that's trying to embrace this channel? So we think there's a lot of opportunity to take down costs and to improve the experience for all the people in the industry.
So 10 years ago, distributed ledger was a fantasy. Everybody was talking about it. There was a lot of excitement around it, but you folks have actually put it into practice. Do you have any advice for asset managers building their own in-house products? How do you make something like that truly frictionless?
Yeah, the good news, I'll tell you, compare this to 10 years ago, people weren't focused on this channel in the same way. And I think today, particularly the larger GPs, but really GPs that want to access the channel, are thinking through all these types of issues. They're thinking through the structure of their products. They're thinking through how these products are delivered. They're thinking through the costs of these products to their advisors and to the clients. And they're really focused on, again, creating the right cost structure and a good experience. We're obviously very focused on that. But I think a lot of people in the industry recognize the need for this connectivity to be automated, to take out all the manual pieces of the infrastructure that we can. By the way, this doesn't happen overnight, so I'm talking about these things, but these are still early in the process of being implemented, and that's the opportunity. And I think we are so early overall in the allocation. When you look at what's happened in the space so far, you look at the advisor penetration rate, you still have 25% of the advisors driving 75% of the business. So the participation rate of advisors is still low, and the allocation rate is still low, right? There's still a lot of folks with no or low single-digit allocation to alternatives. So as you go forward, and the CIOs and wealth management firms are calling for 20% allocations to alternatives, there's a lot left to happen. And so all these types of technologies and innovations, they're not even yet bearing fruit. They will bear fruit today if the market doesn't grow, but it's going to grow. And I think the savings to the ecosystem are massive, particularly when you think about what future allocations will look like.
How do you think GPs change their product offerings because of this channel?
They're structuring them differently. There's certainly a lot of capital call vehicles that are still being marketed, but now there's a number of registered products, direct funds. There are a lot of different ways in which GPs are thinking about packaging their products. And as I said, people are being very innovative. They're trying different things. By the way, not every single thing that is tried is going to be the right answer, but the fact people are trying different things makes a ton of sense. We haven't even talked about retirement. How these assets find their way into retirement funds is another important opportunity that it gets done right, that people understand the differences in a retirement account from your day-to-day investment account. But we think that GPs are going to continue to be very thoughtful and creative around how to package these products.
What role does regulation play in all of this? Are there changes that would open up the industry?
Regulation obviously is a governor on all of this in many respects. We've seen changes to the definition of accredited investors. We've seen recently the willingness to think about how alternatives should find their way into retirement accounts. Obviously a lot more to come on that, and I think the industry is still looking for more clarity on what that might look like. But regulation is obviously quite important to the space, and obviously people are very attuned to that and focused on making sure that they're compliant to whatever the regulations end up being.
You've been participating in this industry for over 30 years. What do you think people are underestimating in the long term?
With innovation, I'd say it's a little bit like my internet comments. Things take longer for new activities take longer to actually happen. We're seeing a lot of press releases, partnerships, a lot of things happening right now, whether it's in retirement and different kinds of structures and so forth. And I feel pretty strongly that a lot of this stuff is going to happen. It just may not happen as quickly as people think. By the way, that's fine. So I think people tend to underestimate the amount of time it actually takes for things to happen at scale. But I think in this context, when things do start to happen, I think they're going to happen in a big way. And so that says to me, you got to be patient. And to my earlier point, you got to have the sort of courage of your convictions, and you got to stick with what you think is happening and be sure to provide the best solutions you can and not be deterred if things take too long. And by the way, that relates very much to how we think about our financing strategy. We raise capital. We're in a long-term game. We are helping clients. We raise one fund. That fund's alive for 10 to 15 years. And so we're financing our business to be here to be a long-term partner to our investors, certainly, but also to our clients on any side of the market. And they need to know that we have the staying power and the business model and the balance sheet to help them over long periods of time. And so that's a big part of how we think about how we finance ourselves as well, recognizing that these are long-lived assets in the first place, and that this is going to take years to play out in the second place. And frankly, that's all very exciting.
And so on that note, what are your thoughts on AI? You're in the data business.
Yep.
Have you seen any effective uses? Are you folks thinking of anything that's practical?
We're using AI across lots of different areas in our business. We continue to hire more AI engineers, and we're looking at really everything we do and trying to figure out, is there an application of AI? What people have to understand is you've got to train a model. It's not like you can buy a PowerPoint, you can buy a presentation or an Excel application and be up and running. You've got to build and train and so forth. So it takes a while to really implement and get AI to a place where it's reliably working on your behalf. But we think it is absolutely transformational, and we're making investments across the various firm, how we build subdocs, how we collect data, how we summarize data. There's lots of different ways that we're using AI throughout the business today, both internally from an operational standpoint, but also in our customer-facing applications.
Lawrence Calcano, thank you for joining us and sharing your wonderful insights.
It's great to be here. Thank you.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.